I'm Matt Bouchard here in New York City for REIT Week 2019, NAREIT's Investor Conference. Joining me today is Vince Tibone, retail analyst with Green Street Advisors. Vince, thanks so much for joining us.
Thanks for having me.
Now, there's many headwinds facing retail, but what's been the biggest positive surprise in your eyes over the past year?
To me, the biggest surprise has been demand for big box space. Following the bankruptcies of Toys R Us, H.H. Gregg, Sports Authority, one of our biggest concerns, will there be enough demand to absorb all of the shadow supply that's hitting the market? Green Street wrote a report about 6 months ago where we looked into what happened to all the former Sports Authority boxes within the REIT portfolio. So we analyzed, how long it took, who took the space of the former Sports Authority boxes that the REITs owned, and what we found is that demand was very broad-based, and that was one of the biggest positive surprises to us. And I think there's a misperception out there that off-price, meaning TJX, Ross, Burlington, are really the only sources of demand out there for kind of your bigger boxes in the open air format, and that's really not the case. And so what we've heard continually here at NAREIT and also at the ICSC conference in Vegas is that demand has remained pretty broad from a wide variety of merchandising categories, and that's been a silver lining in the strip center segment.
Now, next, a lot of people look at the grocery side of the business and they think it's sort of, a constant with little change, but in fact, there's been a lot of rapid change in the grocery business. What's been the impact on shopping centers so far from the growth of online grocery shopping?
Yeah, so far the impact has really been minimal on both fundamentals and CapEx for shopping center landlords. The biggest grocers, Kroger and Walmart, are really aggressively pursuing the buy online, pick up in store option. And the impact of that service has really been minimal to the shopping center experience overall. The only request from landlords really has been to add a few parking spots at the beginning, kind of the front of the store, and no CapEx, no need to really reconfigure the store as of yet. The other aspect is small shop leasing near kind of grocery stores where they're implementing this buy online service. We really haven't seen any positive or negative impacts there. So overall, it seems like we're still in the early innings, and on the ground, nothing yet. Longer term, we do have some concerns about the grocery industry, and do think that your smaller regional grocers could be facing some margin pressure as just the whole industry gets more sophisticated, and grocery pickup or grocery delivery becomes a must-have offering, and we would expect some further consolidation. That's really more of a longer-term impact. Thus far, we haven't seen a big movement on the ground.
And lastly, mixed use continues to be a key buzzword that we're seeing in the retail space. What approach are strip center REITs taking in incorporating mixed use components into their portfolios?
Yeah, so about half the strip center REITs we cover are pursuing some form of mixed use development strategy. Where they really differ in some ways, how they execute on this strategy, where some are choosing to maintain all the development risks. So whether you're doing a big project with multi-phases of retail, office, residential, some are taking on all the development risk and on all the upside. Others are choosing to JV or partner with a seasoned operator or developer within, let's say, the hotel or residential segment, and then maintain the retail portion, maybe where they get a partial upside in some of the non-retail phases, but kind of stay in their core competency. And sometimes they'll also decide just to sell the non-retail portions outright prior to any development, where you're really locking in that value today, but giving away the upside to a third party potentially, but you're really kind of de-risking the development in a way, while still getting the benefits to your existing retail. So if you have the retail center that you own, having an office or residential only helps fortify the strength of that retail offering. So they're differing a little bit. Our view is there's no one size fits all for development. I mean, each project is very unique, and depending on the project, the company's cost of capital, each of those options could make sense. And then one last important thing to remember when it comes to mixed use is that while it's heavily discussed today, when all is said and done and the current projects are finished, for nearly every strip center REIT, non-retail is still going to make up less than 10% of total income. So, it's discussed a lot, but at the end of the day, it's still a small portion of the total portfolio.
Great. Vince, thank you so much for joining us.
Thank you.
For more from REIT Week 2019, be sure to visit NAREIT's website, REIT.com.